This is More Knowledge, More Wealth with your host, Gabriel Shaheen. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. Now here's your host, Gabriel Shaheen.
Good day, this is Gabriel Shaheen, Certified Financial Planner and your host of More Knowledge, More Wealth, here on every weekend, talking about all important topics of personal finance. My job is to go over the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go in our Knowledge Center, which gives you a direct link to YouTube, where we've had well over 1 million views, multiple videos that help answer the questions that you have. And if you want to put an inquiry so we can talk about it on the show or create a Knowledge Center video, please send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And also you can go get this episode, any one of our previous episodes on Spotify, podcasts, you name it, folks. Now, I'm the president of Falcon Wealth Planning. We are a fee-only, non-commission, true fiduciary, folks. And we talk about all important topics of personal finance. That's where you are today, how retirement looks like, investments, estate planning, insurance, folks, you name it. Anything that involves a dollar sign, we can help you with. And we are offering 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost to help relate this show to your specific situation. And we have offices all across the country that we can help you with. Folks, give us a buzz. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, where we can help answer those questions that you have to help with your financial situation.
So there you have it, folks. The federal government, the Fed Reserve, the Fed Chair, Jerome Powell, finally reduced interest rates. And it has happened multiple times before, but it's the first reduction in 4 years since the COVID pandemic. Now, most people thought it was going to be a 25%, now 25 basis points, but a 0.25% drop, a quarter of 1%. Now, later on, it came out that same day, which was on Wednesday, that it was by CME Group, that it was a 63% chance that it was going to be a 50 basis points drop. Sure enough, it ended up dropping 0.5%. Now, that is a pretty aggressive move, especially since the Fed chair said they were going to slowly go into it. Now, during yesterday's conversation, during last week's conversation, they discussed that this move was based on what's called the Taylor Rule, which was economic science that are available out there to determine how much you should cut rates. Now, when you take a look at everything that's happened and just the mild, subtle changes that's going on, and you take a look at the slower GDP growth, which we were expected to be at 2.1, we're on track for the 2%. So it's not like substantially off. We're talking 0.1%, but nonetheless, that was a reason. When you take a look at the higher unemployment rate being on track for 4.4, or the goal was under 4, currently at 4.2, which means more job cuts are coming around. You can even discuss lower inflation with 2.6% versus the 2.8% predicted. These are all signs of economy slowing down, which is when the news came out on Wednesday. Markets were a little confused. They were dropping. Like, it's crazy. When rates were going up, the market was dropping in 2022. You would think with the market drop, the market would like that, would react positive. But the logic is this. With the market drops, maybe these conversations of a recession is more real than not real. This is the issues that came up when the market started to realize it. It was unchanged, but actually kind of slightly down that Wednesday. Because you have to understand, maybe these conversations of a recession are more real than not real. Hence why the government felt the need to reduce rates at 50 basis points versus the originally anticipated 25 basis points. These are the issues that we are seeing right now in the economy. Higher than expected unemployment, and we're seeing this, we're hearing the news, we're seeing a lot more with even the tech companies. Then you see slowing economic growth, that's in our gross domestic product, along with inflation, especially with the amount of money that's been printed and spent and so on. So the Feds felt they had to do a drastic change. They felt they had to move forward a little bit more aggressive to help with the soft landing. And so with that 50 basis points move, the idea is this. You most likely have debt, whether it's credit card debt, whether it's on a line of credit. Well, those are variable based on prime rates and Fed funds and so on. So when the rates get cut, and we've already seen the Treasury starting to drop under 4%, closer to 3.5%. We're already seeing this now. So the idea is people with debt now don't have to spend as much. Now, if you're holding a $100,000 line of credit, a 50 basis points move, well, that's $500 of savings. Some businesses out there, by the way, have billions of dollars on lines of credit. So as the rates change, they now have more cash flow. $500 a year, assuming you have a $100,000 balance, if now that has dropped 0.5%, right? 1% of $100,000 is $1,000. 0.5% is $500. That's about that's about $40 a month of savings. I mean, $40 does help people, and this may be the first signs of continuous rate drops, especially if the economy is continuing to slow and unemployment is rising. So the conversation we have to all ask ourselves is what gives, what is happening, and what is changing. By the way, folks, if you're just joining me, you're listening to Gabriel Shaheen, Certified Financial Planner, and your host of More Knowledge, More Wealth here, and every weekend talking about all important topics of personal finance. And today we're just talking about the rate cuts that has happened and what's to expect into the future. And our government's job, they did a good job. I know it's so easy to make fun of the government, whether you're for Trump, Biden, Kamala, whoever. It's just easy to do because it's so easy to just complain, right? But it's coming up with a solution. That's everything. And with the situation that's come up recently with the rate cut that we're at, well, you got to understand interest rates, if you look 4 years ago, or if you look actually 2 years ago, maybe 3 years ago-ish, well, we were having ridiculously historical low interest rates. I mean, you could get a mortgage for 2.5% over 30 years. Man, in hindsight, wasn't that smart? And so you have to look at where the economy was. There was a reason part of the booming took place. And then with the interest rate increasing in 2022, well, what happened? Well, what happened is the market didn't like it because that's more expensive for you, more expensive for housing, it's more expensive for credit card debt, line of credit debt. Corporations had left profits. They had to adjust accordingly. So what did they do? They increased their prices. This is all a form of monetary policy to create inflation. What the federal government did recently is a form of monetary policy to be able to control the negativity of these high rates. There's fiscal policy as well. Now, states like California haven't done a good job with that. Why? Because they've raised minimum wage prices. That causes more inflation, costs to go up. A Big Mac meal costs $13 to $15, depending on the location, at McDonald's. So you have to always take a look at just the economy as a whole. And if you want to, by the way, make $1 million, forget $1 million, $1 billion, actually $1 trillion, be the first trillionaire our world has ever seen. All you have to do is take the information today and see what the ramification of the decision that is made today in the future. By doing that, you're able to predict the future and the outcomes. And that's what makes some good economists and not good economists, is taking a look at information today and what happens in the future with the changes made today. And historically speaking, which there is no guarantee that what happened in the past is going to give you the same results for the future. But my goodness, it's a strong indicator. And our Fed Chair, Jerome Powell, decided to go towards a 50 basis point cut versus a 25 basis point, 0.25%, right, versus 0.5%, based on certain rules of economics that are out there. And so this is a key element of Economics 101, which will help. It's just funny to me. When the rates go up, market drops. Now they cut the rates, the market drop. Now, if you do look in the past few days, when you look at Thursday and a few on, the markets did do well, right? They performed pretty strongly, right? They reacted well because they're realizing, right? The first, it was like, oh my gosh, there are actually signs of a recession that's coming up that were brought up in the conversation, as we discussed earlier. But now you start looking at the reaction piece of it and the positive implications of a 50% or a 50 basis point, 0.5% drop. This is going to be good. It's going to be good long term. Everything becomes that much more affordable. You know what's not good, though, is money market rates, CD rates. Even though there isn't a 100% correlation to that, there is a still very strong correlation. So yes, they're not brothers and sisters, but they're cousins. And so banks make money off lending. And if the spread is now lower, they make less. And so now I say that with an asterisk, right? Because of this, because it's not a dollar-to-dollar ratio, but because of this, actually financials have actually done well. Now, when I say that, it's pretty early. We've only had Thursday and Friday for this, but they've done relatively well because now their deposit dollars drop a little bit more, and they get to leverage that out multiple times to do other things with the money. More people might be excited to borrow now because the rates are lower. These are all important impacts that happen in the markets. And this is what economists are doing. And economists, where do they work? They work at fund companies, investment companies. And these are crucial elements to make sure the success of their investors and understanding markets, the way it reacts, because people freak out. Professionals don't. You have to look at the profitability side of everything that's going on. There are certain investments that will do poorly during everything that's happened with the interest rates drops. And there's other companies that are going to do fantastic. Your job is to invest in a diversified portfolio to take advantage of everything. We don't know if this is the only drop. I would think there's going to be more. But even then, it's taking a look always at what next steps that you should be doing in your portfolio. If you need help with that, we can do it. We have offices all over. Would love to take advantage of it, show you these steps that are necessary. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Folks, we're going to go on a quick break. When we come back, we're going to talk more about this Taylor rule and other signs, and not just the direct impact this has, but potential indirect impact. We'll be right back after a few words.
This is Gabriel Shaheen, Certified Financial Planner and President of Falcon Wealth Planning. We wanted to offer you a free financial assessment for listening to the show so you can help relate it to your specific situation. We offer multiple services such as retirement planning, where you are today, how retirement looks like, talking about Social Security, real estate, planning, even if you own a business. Talking about taxes, not just how to save money today, but also throughout retirement. Talk about investments, making sure you're avoiding those high fees, costs, commissions. And also estate planning and insurance, just making sure you're properly protected if, God forbid, something were to happen. And we're offering 1 to 2 meetings, 1 to 2 hours of our time at no cost. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, and fill out the form fill right there on our site. We would love to help you in your financial situation. We look forward to serving you.
Welcome back, folks. This is Gabriel Shaheen, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every weekend, and we are talking about just all important topics of personal finance. And the first one is kind of the elephant in the room, if you will, talking about interest rates and the drop and how that impacts you. And there are multiple sides to the story. And the government decided, based on a Taylor rule that was brought up back in 1992 by John B. Taylor. I love how these people always name it after themselves. They're so humble, I swear. But it's based on monetary policy, which is what I discussed in that first segment, suggesting how central banks should adjust inflation or interest rates to respond to inflation and economic output. And I get it. It makes sense. I'm seeing it right here. And there's an actual formula for it. And the basic factor of this, as I said, I'll discuss this Taylor rule, is inflation, is the general increase in prices over time. GDP, the economic indicator that measures the size of an economy's total production, and interest rates, the overnight lending rate between banks. Now, when you take a look, it is important because the circumstances during economic stress is vital. And when you look at rise of interest rates, you know why they do that? You know why our government has done this forever, not just since 1992? It's when inflation is higher than the target, or when economic output is growing too quickly. They are able to control that by making the costs more pricey for people, making it more expensive to control the growth. And why do they lower interest rates? It's because inflation is lower than the target, or when the economic output is growing more slowly than expected. And that's what we're seeing. And the validation is through higher unemployment. Why? Because companies want profits. At the end of the day, that's all that matters to anybody, is more money in your wallet book. Isn't that all you care about when you're working? How could I make more money? Sure, there are some people that want comfort, balance, work-life balance, and so on. But you know what? You can find the easiest job out there, but it just won't pay you. Something that will make you absolutely super happy. But if it can't pay the bills, it's not realistic, right? Certain things to make us happy, we do as hobbies. So the logic here is you have half camp that's happy with the lower interest rates, half camp that's unhappy. The unhappy camp are those thinking about this could be the beginning of a recessionary cycle. Sure, political season is coming up. I get it, makes a lot of sense. But when you take a look at right now, the production slowing, companies, whether it's tech companies or aerospace companies or whatever companies, doing layoffs. When you're taking a look at other economic signs of basic concepts of our growth is just not as good as it used to be, and everybody wants American stuff. It's the most regulated, it's the highest quality. Now, it depends on what you're talking about here, right? For purses, people like French stuff. For shirts, they like European stuff. You know, there's other items here that are good, made in America versus not. But when you look at maybe steel products, when you look at just like Levi's jeans compared to other jeans around the world, like people still value American-made goods around the world. Proof is, go to an international mall. Maybe it's the fancy mall, depending on where you live. It is packed, and you have a lot of foreigners buying a lot of goods. So the fear that people are just not buying as much as they used to is real. And we have to take that into consideration. And the government is validating economic concerns by reducing rates, not 0.25%, but 0.5%, saying, hey, we do not want to fall in a recession. And it's their job to try to stop that from happening. Now, the positive sign of this is, man, government, great job. You just made everything a little bit more affordable. I've been wanting to buy a house, but I'm waiting for interest rates to come down. Now, hold up. When they lower the Fed rates by 50 basis points, so some of your line of credits are based on prime and so on, that's also 0.5%, that 50 basis points. When the Feds cut those rates, it doesn't mean right then and there home prices drop by 50%, or excuse me, by home interest rates, your mortgage, if they're currently at 6.5%, they don't instantly go to 6%. That is based on the United States Treasury, which is something, quite frankly, you and I control through inflows and outflows, through supply and demand. And so the positive piece of this is there is a logic that we can now afford more things with lower interest rates. And we saw that during the housing boom, during the rate cuts of 2020. They were already low, and they made it lower. Why? Because they were worried, scared to death of complete economic destruction, which, oh, by the way, it happened. They shut down everything. The government shut down the world, but our government pretty much shut down America. So the idea is that with lowering rates, they're trying to help you. Yes, yes, yes. Believe it or not, the government is trying to help you. And this is the positive angle of it. The positive angle is quite simple. Is when costs come down, it's not just for you, but it's also for the companies that you invest in, which provides higher cash flow for them, which, oh, by the way, could help with increasing our GDP growth. When they have extra money in their pocket, they don't want to buy a dividend or submit a dividend and pay it out. They want to reinvest it to grow their company. And when a company, oh, by the way, saves 0.5% on $1 billion of debt, that is major, major money. So, by the way, folks, if you're just joining me, you're listening to Gabriel Shaheen, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every weekend. And we're talking about all important topics of personal finance. And of course, our federal government, the Fed chair, Jerome Powell, reduced rates by 50 basis points, which is 0.5%. By the way, 100 basis points is 1%. All right, just to kind of let you know, 25 basis points is 0.25%. So when you look at your portfolio now, the logic would suggest, and this is why when you see interest rates in your money markets, which are a variable rate, right? They change, quite frankly, every day, every week. When you see interest rates cutting down, that should naturally be dropping down a little bit. So what happens also from an investor point of view, if they're seeing that their interest rates are going to be dropping, they're going to want to deploy that capital somewhere else. And a lot of investors have two mentalities. Number one, maybe you can capture a bond that hasn't dropped in price that much, or the rate hasn't dropped that much, and you can buy maybe a 5% bond. Lock that in for 5 years, 10 years, or whatever. You're going to be getting 5%. Now, if you do that now in that intermediate term bond and rates continue to go down, well, that 5% bond, it gets more and more attractive every year. The principal value goes up of that bond in addition to still collecting 5%. Now, there's a whole science and math behind that, right? Because maybe that 5% bond now, there's only 4.5% bond. Well, so you can actually redeem that fairly easy. Some say they're not liquid, but quite frankly, it's all relative based on what's available in the marketplace. You'll get a premium. People will pay you. If you put $100,000 in to get $5,000 a year, because it's 5%, well, now bonds are paying, let's say, 4%. That's $1,000 less a year that you get. Well, if you have 10 years remaining, that's technically $10,000 less. Maybe your bond has appreciated in value. Now, would it appreciate $10,000? Your $100,000 is worth $110,000? No, because there's opportunity cost of that money. So there is a science behind it, but that's the logic. So some people are now deploying their money to go into bonds. Others are looking to deploy it into stocks. Some of it may be value companies, which is why value companies are normally very popular. They pay dividends. They're very consistent. They're not trading at extremely high volumes. It would be nice because it has low book to equity, low book to value ratios. The value of the company based on what they're making is actually pretty low. It's a value purchase. Everybody likes values. That's why we go to Costco, right? So this actually helps the stock market by people saying, well, I have to put my money somewhere else. Now, it's not happening now, but for experienced investors, they're starting to realize they see what's coming down, and they see that interest rates are going to be dropping, and they have to put something with put their money to use. This is another way the government, through monetary policy, is able to control recessionary and expansion periods. We could argue we hit the recession already. The reason they didn't call it a recession is because of unemployment rates were in the high threes at that time. Well, it's continually to get higher, and it's going higher, and our government's trying to control it. So this is where you need to take a look at your portfolio and decide, what are you going to do? And this is why we're offering a free financial assessment, where we're offering 1 to 2 meetings, 1 to 2 hours of our time at no cost. And we want to discuss topics with you of how your portfolio is prepared, not just what happened last year or this year, but what's going to happen. And we do know is interest rates are coming down. And what worked for you yesterday may not work for you tomorrow. Let us help, folks. We have offices all over. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. We can help put something together for you that at least you're able to participate, still be protected, still have liquidity, and with all due respect, your goal should be that you worked hard for your money. You want your money now working hard for you. And with that, you need to be able to put it to work. That's one of the biggest rules in money management, in wealth accumulation, and growth. Do something with your money.
That was a fast show, folks. I want to thank you for tuning in with us this weekend. You can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go and visit our Knowledge Center, which redirects you to YouTube. We have over 1 million views, folks. And if you want us to discuss anything on YouTube, on the show, whatever, send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And if you want this episode, any one of our previous episodes, you can go on podcast, Spotify. We have them all there. And folks, we want to thank you for your trust. We want you to feel free and feel comfortable to reach out with any questions that you have. I want you to have a fantastic weekend. Have a great week, and God bless.